Senator Crapple.
Thank you, Mr. Chairman. Chairman Bernanke, ever since the DoddFrank conference, there's been a debate about whether non-financial end users were exempt from margin requirements. Then Chairman Dodd and Chairman Lincoln acknowledged that the language for end users was not perfect and tried to clarify the intent of the language with a joint letter. In the letter, they stated the legislation does not authorize the regulators to impose margin on end users, those exempt entities that use swaps to hedge or mitigate commercial risk. In April 2011, prudential regulators issued a joint proposal that would, in fact, require non-financial end users to post margin to their bank counterparties. According to the proposed rule, the proposal to require margin stems directly from what they view to be a legal obligation under Title VII. Recently, I offered an amendment with Senator Johans to fulfill congressional intent by providing an explicit exemption from margin requirements for non-financial end users that qualify for the clearing exemption. The amendment is identical to the House bill, which passed the House by a vote of 370 to 24. Is it accurate, in your opinion, that regardless of congressional intent, the banking regulators view the plain language of the statute as requiring them to impose some kind of margin requirement on non-financial end users unless Congress changes the statute?
We believe that the statute does require us to impose some type of margin requirement. We try to mitigate the effect as much as possible by allowing for exemptions when the credit risk associated with the margin was viewed as being sufficiently small. So many small end users would be exempt in practice.
Do you agree that the non-financial end users hedging does not contribute to systemic risk, that the economic benefits from their risk management activity, that the economy benefits from their hedging activity, and that it's appropriate for Congress to provide an explicit exemption from margin requirements for non-financial end users that qualify for the clearing exemption?
I certainly agree that non-financial end users benefit and that the economy benefits from the use of derivatives. It seems to be the sense of a large portion of the Congress that that exemption should be made explicit, and speaking for the Federal Reserve, we're very comfortable with that proposal.
Well, thank you, Mr. Chairman. I want to shift gears for just a minute back to the question that the Chairman asked with regard to what actions you can take. You indicated in your response to his question about what tools you still have and how you may approach them, that you still have some possible tools to deal with. There's obviously a lot of speculation and concern about whether you are considering another round of quantitative easing. There are a lot of questions about how effective the quantitative easing has been to date and what more can be done. Could you discuss for us a moment how effective you feel that the quantitative easing has been so far, and whether you feel that it is one of those tools that you should seriously consider going forward?
So as I mentioned to the Chairman, we ran out of space to lower short-term rates in the normal way, and we had to look for other tools. Like a number of other major central banks, we've used asset purchases as a way of providing additional support to the economy. Economists differ on terms of how effective the tools have been. My own assessment is that the quantitative easing and the Operation Twist so-called tools have been effective in easing financial conditions and in promoting strength in the economy. I think it was most evident in the so-called QE1 in March 2009, which was followed a few months later by the beginning of the recovery, and by a few days by the trough in the stock market. QE2 was certainly effective at addressing what was beginning to become a worrisome amount of risk of deflation. In the fall of 2010, that issue was addressed. My view and the view of our analysts at the Fed is that it also contributed to economic growth. It's hard to judge because it depends on what you think would have happened in the absence of those actions. So there's a range of views about the efficacy of these programs. There's also questions about side effects, risks that might be associated with their use, and therefore I think they shouldn't be used lightly. Nevertheless, my own view is that these tools and other non-standard tools still do have some capacity to support the economy. And what we'll be looking at in thinking about this is, I think, really two things. The first is, as mentioned in our statement, whether or not there is, in fact, a sustained recovery going on in the labor market, or are we stuck in the mud, so to speak, in terms of employment. That's, of course, our maximum employment mandate. And then the other issue would be price stability, and notably, we would certainly want to react against any increase in deflation risk.
Thank you.